All right, tech enthusiasts, buckle up. We're diving headfirst into the hottest rivalry in the tech world, NVIDIA, AMD, and Intel. These semiconductor giants are locked in an epic battle for supremacy, and the stakes couldn't be higher. We're talking about the future of AI, data centers, and the very chips that power our world. But here's the question that's burning a hole in my circuits. Who's really calling the shots in this silicon smackdown? And more importantly, which one deserves a spot in your investment portfolio? This isn't just about numbers. It's about vision, innovation, and the raw power to shape the future. So, let's crank up the clock speed and get started. Let's kick things off with the current king of the hill, the undisputed AI powerhouse, NVIDIA. If you've been even remotely curious about artificial intelligence, you've undoubtedly heard their name. And for good reason. Their recent Q4 earnings were, frankly, mind-blowing. We're talking about a staggering $39.3 billion in revenue, almost double what they pulled in last year. And the EPS? A cool 89 cents. This isn't just growth, it's an explosion. The driving force behind this meteoric rise? The insatiable demand for their GPUs from AI titans like OpenAI and Meta, all scrambling to build the next generation of AI. Think of it as an arms race. But instead of bullets, they're hoarding NVIDIA chips. Their Blackwell architecture is a game-changer, adding a whopping $11 billion to their Q4 revenue alone. These chips are so hot, so in demand, that NVIDIA is struggling to keep up with the orders. Can you imagine having that kind of problem? But here's the million-dollar question. Can this rapid expansion strain their margins? Possibly. NVIDIA has acknowledged some cost pressures in scaling up production. But let's be real, the AI trend shows absolutely no signs of slowing down. And that puts NVIDIA in a prime position to continue its unbelievable, almost unbelievable, perma-rally mode. For investors craving a direct piece of the AI pie, NVIDIA's near monopoly on high-performance GPUs, coupled with a reasonable 30x multiple on next year's expected EPS of $4.43, makes a seriously compelling case. This isn't just a stock, it's a ticket to the future. So, what's the crystal ball say about NVIDIA's stock in 2025? Well, Wall Street is overwhelmingly bullish. We're talking about 31 buy ratings and only 2 holds in the past 3 months. Not a single analyst is screaming sell. That's pretty remarkable. The consensus estimate points to an average price target of $179.77 per share, suggesting a potential 41% upside from current levels. And with the momentum from their post-earnings results, NVIDIA stock might be gearing up for an even bigger move. Hold on tight, folks, because this ride might get even wilder. We're talking about serious potential for growth. But remember, past performance is never a guarantee of future success. Always do your own research and consider your risk tolerance before making any investment decisions. Now, let's shift our focus to the underdog, the company that's been quietly building a serious empire, Advanced Micro Devices, or AMD. While NVIDIA hogs the spotlight, AMD has been stacking up its own impressive wins. Under the leadership of CEO Lisa Su, AMD's Q4 revenue hit a solid $7.7 billion, a healthy 24% jump over last year. But here's the real kicker. Their data center revenue soared by a massive 69%. This isn't just good, it's phenomenal. It signals that AMD is no longer a second-string option. They're playing in the big leagues, and they're winning. A major driver of this success is AMD's EPYC CPU lineup, which now claims more than 50% market share at top cloud providers like AWS, Microsoft Azure, and Google Cloud. Remember the days when AMD was seen as the budget alternative to Intel? That's ancient history. Today, EPYC chips are powering serious enterprise workloads where performance per dollar truly matters. This isn't just about being cheaper, it's about being better. And AMD is proving that they can deliver. Their push into AI accelerators also deserves some serious attention. AMD's MI300 series GPUs have started appearing in large-scale deployments, and the next-gen MI350 is set to reach customers later this year. Yes, NVIDIA still dominates the AI accelerator space, largely due to its entrenched CUDA ecosystem. Think of CUDA as NVIDIA's secret sauce, a platform that developers have been using for years. However, AMD's ROCm software platform is constantly improving. And if it keeps winning over developers and data center managers, AMD could significantly expand its foothold in the AI-focused infrastructure. This is a marathon, not a sprint, and AMD is showing the endurance and the strategy to go the distance. So, what's the verdict on AMD stock? Well, Wall Street analysts have a moderate buy consensus. That's a pretty solid vote of confidence. We're talking about 25 buys, 11 holds. and just one lonely sell in the past 3 months. The stock's average price target of $147.88 suggests a potential 44% upside this year. That's right, 44%. This signals strong growth expectations ahead, much like NVIDIA. Both companies are poised for significant gains, but remember, the stock market is never a sure thing. There are always risks involved, so make sure you do your homework before jumping in. Consider factors like market volatility, competition, and global economic conditions. Now, let's turn our attention to the former champion, the once unquestioned ruler of the CPU world, Intel. Intel, the name that was once synonymous with computing power. But things have changed. Their latest quarterly sales were $14.3 billion, up 7%. That sounds decent, right? But their full-year sales were soft at $53.1 billion, down 2%. These numbers aren't catastrophic, but they do reflect an urgent need for a strategic pivot. The industry is evolving at breakneck speed, and Intel appears to be struggling to keep up. The company has seen multiple leadership reshuffles, and the new interim co-CEOs, Michelle Johnston Holthaus and Dave Zinsner, are trying to streamline operations. But here's the question. Are two sets of hands better than one? It's not always the case. Intel's push to become a major foundry competitor to TSMC and Samsung is still underway, but progress hasn't been smooth. They're facing some serious challenges in this area. On the product front, Intel remains dominant in many existing data center CPU deployments, but they appear to lag behind in AI-focused hardware. Projects like Falcon Shores have been scaled back, and their AI data center GPUs seem overshadowed by NVIDIA's and AMD's newer offerings. This is a tough spot for Intel. They're trying to reinvent themselves, but they're facing stiff competition and some internal challenges. But Intel isn't throwing in the towel just yet. One notable angle they've been vocal about is security. By pointing out potential vulnerabilities in rivals' products, they aim to position themselves as the safest choice for enterprise clients. Could that angle work? Possibly, for risk-averse buyers. But it may not be enough to counter the surging demand for high-performance computing and AI. Security is important, but performance is often the deciding factor for many businesses. Intel needs to find a way to balance both. They need to innovate and compete on performance while also highlighting their security advantages. It's a tough balancing act, but it's essential for their future success. So is Intel a buy, hold, or sell? Well, Wall Street remains cautious. They've assigned it a hold consensus rating with just 1 buy, 27 holds, and 5 sells in the past 3 months. That's a pretty lukewarm reception. The stock's average price target of $22.69 indicates a potential 5% downside over the coming 12 months. This reflects the apprehension about the stock's near-term prospects. Investors are clearly waiting to see if Intel can turn things around. They need to show some concrete progress in their foundry business and their AI initiatives. Until then, Wall Street is likely to remain on the sidelines. Let's dig a little deeper into Intel's problem child, as Raymond James analyst Srini Pajjuri calls it, their foundry business. This operation is currently losing money, and Pajjuri expects a potential split to come. The foundry business lost around $13 billion last year and is projected to lose around $5 billion this year. That's a significant drain on Intel's resources. Pajjuri also points to the foundry business as the main reason Intel's share price has been declining in recent months. This is a serious issue that Intel needs to address. They need to find a way to make their foundry business profitable or consider other options, such as a spin-off or sale. On the bright side, Intel's product division is in much better shape. While it's not growing as fast as it used to, it still generates around $50 billion in revenue with an operating margin of around 25%. That's a solid performance. The product division is stable and profitable, making it a far more attractive business than the foundry. If the foundry business were removed from the equation, Pajjuri believes Intel stock could be valued in the high 30s or so. This highlights the potential value that could be unlocked by addressing the challenges in the foundry business. It's a complex situation, but it's clear that Intel has some valuable assets and opportunities. And speaking of Intel's product business, they recently announced an augmentation to their Granite Forest line. These processors are geared towards the server market, specifically for hyperscalers and cloud builders who want to cram as many cores as possible into a socket. This means fewer actual servers are needed to run operations, which can lead to significant cost savings for businesses. The Granite River processors, the Xeon 6500P and Xeon 6700P, are the core of this line, but there are multiple models designed to provide processing power for various use cases. This should help Intel capture a larger share of the market. It's a positive sign that Intel is continuing to innovate and develop new products. They need to keep pushing the boundaries of technology to stay competitive. Unfortunately, it's not all good news for Intel. They are currently facing investor lawsuits related to their foundry business. Several law firms have announced class action lawsuits against Intel, alleging securities fraud. These lawsuits could potentially lead to significant financial penalties for Intel. These lawsuits add another layer of complexity to Intel's challenges. They need to address these legal issues while also focusing on improving their business performance. It's a difficult situation, but they need to navigate it carefully. So, who sits on the semiconductor throne right now? Ultimately, NVIDIA and AMD represent very reasonable investment options. NVIDIA dominates the AI-driven market and holds a near monopoly on GPUs. Their sales are off the charts, and expectations are sky-high. Meanwhile, AMD continues to expand in both CPUs and GPUs, offering strong performance for the price. They are a genuine peer to NVIDIA from both an end-user, enterprise, and investor perspective. These two companies are leading the charge in the semiconductor revolution. They are driving innovation and delivering impressive results. They are the clear frontrunners in this race. And then there's Intel, the third wheel in this matchup. A legacy player with plenty of former glories and current challenges. They remain a juggernaut, nevertheless, and are implementing a raft of policy initiatives and market innovations to regain their former stronghold. I'm bullish on NVIDIA and AMD for slightly different reasons. But Intel is a bit like an oil tanker. Huge and able to carry valuable assets at great distances, yet agility challenged and has the turning circle of a small sea. For any Intel bulls out there, ship ahoy. It's going to be a long journey, but they have the potential to turn things around. But for now, NVIDIA and AMD are the companies to watch. They are the future of the semiconductor industry. What do you think? Are you Team NVIDIA, Team AMD, or do you believe Intel can make a comeback? Let me know in the comments below. And don't forget to like and subscribe for more tech analysis and investment insights. Thanks for watching.